When negotiating the purchase of a business acquisition, there are really two levers. One is price and the other is terms. And I often think about price and terms as dancing partners because when one moves, the other has to move with it. And I'll explain what that means in a second. Price is fairly obvious. Price means here's what you're going to pay for the business. Here's the price tag. It's $1 million. It's $500,000. It's $50 million. It's $5 billion. That's fairly easy for everybody to understand. What is not as obvious is that it is very rare that a business is paid for on a cash only basis. You don't show up to somebody's company, open a briefcase full of $100 bills, and say, hey, I want to buy the business. Snap. Are you interested? It doesn't work that way. So generally, there are terms involved with buying the business that actually can impact price. For example, what if you want the seller to stick around for 6 months to a year to help transition the business, to help transition customers over to you or transition other key relationships? The seller may demand a little bit of extra money to compensate them for their time in doing that. So that may push the price up. On the other hand, what if the revenue seems to be kind of risky? It's volatile, or 40% of it is wrapped up in one customer. What do you do then? Well, one thing you might do as a buyer is say, look, I'll give you $1 million, but then you have to earn another $500,000 by making sure that those customers stick with me. That's called an earnout. So that's a term of the business. And what that does is that shares the risk between the buyer and the seller, and also holds the seller accountable to make sure that what the seller is representing to you as the buyer, that it's actually true. So that puts what we call skin in the game. Another term is structuring the transaction as either a stock sale or an asset sale. And generally speaking, an asset sale gives the buyer tax advantages and a stock sale gives the seller tax advantages. And whether or not something is structured as an asset or a stock sale will also have an impact on price. So as a seller, I may not be willing to accept a $1 million purchase price if it's an asset sale because of my higher tax burden. I may want $1 million too to make myself whole. And the buyer may say, well, this price doesn't make sense unless I can do it as an asset sale. And so there's a tug of war, and that's what I help do, is help people negotiate that tug of war between the two parties that are trying to determine whether this will be an asset purchase and a stock purchase, and what that impact will be on the final price. There are many other terms that will go much farther than we can go in one short video, but those are the top 3 terms that you're going to encounter in a business purchase scenario. And just bear in mind that price and terms are dancing partners. The third element of buying a business is understanding how you're going to pay for it. Now, maybe you're in a situation where you can pay all cash if you choose to, and if you're in that happy situation, that is often the cleanest way to get a deal done. Everybody likes an all-cash buyer, less fees to get the deal done. That's great. But the reality is that most deals are not done on 100% cash terms. And so the buyer may need to raise money from a private equity fund, or raise money through bank financing, or if it's a small business, through a small business administration loan, or even convince the seller to offer what's called seller financing, which is that you actually get a loan from the seller to pay for acquiring the business over a period of years. We call that seller financing or a seller note. And each one of those financing sources has their own pros and cons. Private equity means that you're generally going to have to share control with your investor. It generally means that when you're going to be forced to sell your business at some point to make sure the private equity buyer achieves liquidity, and you're going to pay out a chunk of the proceeds from the sale to generate return for the private equity buyer. But on the other hand, private equity buyers are generally willing to accept risks that a lender will not. With a bank loan, you generally are not going to share control with a banker. Banks don't want to step in and run companies. When a bank finds they have to step in and run a company, that already means that something's gone really wrong. It's not something they want to do. But the cost of financing is generally reasonably low. SBA loans are somewhere around 7.5% right now. You can deduct the interest as a business expense generally, which means you might be paying 5.5 after taxes. That's very attractive. The downside of a loan, however, is that generally speaking, you have to make a monthly payment. And so you must make sure that your business in the short term can cash flow enough to sustain the financing that you obtained to buy the business. The third financing, seller financing, is often the most attractive because the seller doesn't want to take back the business. So once you achieve or obtain that financing, if things start to go a little sideways, often a seller is going to have a lot of incentive to work with you. Again, they don't want to buy the business back. But the downside to that is that many advisors will tell sellers never to accept seller financing because their experience has been that the rate of default on seller financing is high. Now that, in fairness, that has actually not been my experience. I've seen seller financing work very well more often than not, but that may be a function of the analysis that was done. So the third rail, if you will, of the transaction is understanding where the financing is going to come from. And that's going to determine, frankly, how expensive a business you can afford. And so you won't waste your time pursuing businesses that are too expensive, but also will make sure that your opportunities are properly calibrated so that you don't feel like you're limited to less expensive and less attractive businesses than, in fact, you can afford thanks to financing. If you want to know more about that, contact me because I can help you understand how those terms work, how you can negotiate those terms to your benefit, and make sure that you come out of the deal with the best outcome possible to help you win the deal. So having an experienced transaction advisor can be a big help to a client buying a business. First, if you've never bought a business before or you haven't done it very often, there's a skill set that comes with buying a business. And frankly, and I have an MBA, but most MBAs I don't think really teach you how to buy a business. You understand that through experience in the deal world. And having an advisor helps you understand a lot of the nuances that are going to take place over the course of any deal. For example, there's a saying that deals die 100 deaths before they actually get done. And I found that to be true. And having an advisor will help you overcome hurdles that alone you might think are insurmountable, but an advisor who's seen a lot of deals, has seen a lot of things take place, can often find solutions that can keep that deal alive. Second, a good deal advisor brings a level of objectivity to the deal that is really important. Having an advisor will give you a sense of emotional distance in a deal to make sure that your emotions don't play an outsized role in driving your decision making. And again, human nature is such that once you invest 6 to 9 months and potentially thousands of dollars in investigating a deal, we call that due diligence, that you just want to get the deal done already. You don't want to feel like you, quote, wasted all that time and all that money to then not do a deal. And the role of an advisor can be to remind you that you don't want just any deal, you need the right deal. And if the deal turns out to not be right, it's way more expensive to do a bad deal than it is to walk away after spending the money on recognizing that you have a bad deal that you walk away from in the first place. And then finally, I think that what a good advisor does is they clarify the options that you have in front of you. And this often happens or takes place with good, solid financial analysis, and will help you answer questions like, can you afford to pay for that business with your current financing options? How risky is the acquisition of the business if you decide to take out debt? What is your margin for error? What is the probability that the business itself will fail to cash flow and then you're going to be in trouble repaying that debt? What is the likelihood of good exit outcomes within 5 years? And will you be able to do what's necessary to produce that kind of outcome that will be attractive to a private equity buyer? So an advisor can be very helpful in narrowing down the menu of choices for getting your deal done. So instead of And I liken it to this. Instead of walking into a restaurant that has no menu and they ask you, what do you want? Most people would have a lot of pause. You wouldn't know what to order. Like, well, what do you have? What can you make? What's really good here? And that's why restaurants have menus. But when you have a menu in front of you, especially a small one, you can make a decision fairly quickly and with a fair amount of confidence because there's a finite number of alternatives. I think my favorite success stories was with my longest tenured client who I met when, as a company, they were going bankrupt. And they cleverly identified a company acquisition as a way to strengthen their company because they found a seller that was in the same space and was motivated but wanted to pursue a business model. My client had despaired of buying that business because they said, well, I can't write that kind of check, so I guess I can't buy that business. But once we spent some time together, we found out there was external financing available. There were banks that wanted to lend money for that business. And we also discovered that the company was willing to provide seller financing. So in effect, we were going to use the business's own cash flow to pay for the business. And so again, going back to the deal terms, we did pay a little bit more than sort of the cash in the barrel value of the business, but not terribly so. And then within 5 years, the company had paid off all of its debt. And my client wound up several $1,000,000 to the good in terms of their net worth because they had a positively cash flowing business that was free and clear of debt and was now actually contributing strategically and in a synergistic way to the business that my client had in the first place. That is one of my favorite success stories. If you want to know more about that, contact me because I can help you understand how those terms work, how you can negotiate those terms to your benefit, and make sure that you come out of the deal with the best outcome possible to help you win the deal.